What is the net investment income tax? And what can you do to minimize the impact of this on your own tax situation? The net investment income tax is a tax that was passed under the 2010 Affordable Care Act. And it adds an additional tax on net investment income if your adjusted gross income is above the threshold. The threshold is $250,000 for married filing jointly, $125,000 if you're married filing separately, and $200,000 for everybody else. Now, that is an amount that was set in the law in 2010. That does not adjust. It's still those same limits, and there's no provision in the code for it to adjust in the future. So the thresholds that I just gave you are the thresholds in place for the net investment income tax. If you have adjusted gross income above that threshold, then the lesser of the amount that you're above the threshold or your net investment income tax is going to have this extra tax added to it. The extra tax is 3.8% of that amount, the net investment income or the amount that you're over the threshold. And that 3.8% tax is stacked on top of whatever tax you're already paying on those dollars. So let's say that you're above that threshold, you've got net investment income that is capital gains, and you pay 15% on capital gains, then you would pay a total of 18.8% on the capital gains that are above the threshold. If it's ordinary income tax that you're paying tax on, maybe it's interest and some other things that are taxed at ordinary income rates, then you would take your ordinary income tax bracket, for example, if that's 24%, and then you would add the 3.8%, so you would get 27.8% for those dollars that are taxed that are over and above that threshold. While 3.8% is not a lot, we don't want to pay extra tax. We are already paying a lot of tax. And so what can you do to help yourself minimize the impact of any net investment income tax? One thing that you can do is reduce your net investment income. Move some things that are in your taxable accounts to tax deferred or tax exempt or tax free, whatever you can do to shelter that from creating current taxable income. Now, you want to think about that in light of your long-term plan as well, because we don't want to just save 3.8% and create a bigger problem later. But by moving some of those dollars into a more favorable tax position on a current basis, then you would not be subject to net investment income tax on that. One example would be to move some of your taxable interest earning investments to municipal investments that pay a tax exempt interest. The second thing that you can do is reduce your adjusted gross income. If you can keep yourself from going above the threshold, then it doesn't matter what your investments are generating. You will not be subject to the net investment income if you're not above that threshold. Now, the threshold is based on adjusted gross income. So anything what we call below the line, like your itemized deductions, are not going to impact this number. Instead, what you have to do is look at what is impacting that above the line number that's coming into adjusted gross income. Can you possibly adjust the timing of some income so that you don't get a big chunk of income in one year and not as much in a different year? And if you have a business, can you increase some of your expenses in one year where you have higher income versus a different year when you have lower income? You want to think about how you can reduce your income above the line so that you can keep yourself under the threshold as much as possible. And last but not least, it's always a good idea to look at your investments. Where are they located? What do you hold in your taxable account versus your tax-free account versus your tax-deferred account? Where are those investments held so that the ones that generate the worst results as far as this particular tax goes, those are in an account where that's going to be sheltered. It could still be a great investment, But by moving it into an account where some of that income is sheltered from these extra taxes, then you get to keep more of whatever you're earning for yourself. And that is always the idea behind doing good tax planning, being able to legally and efficiently and effectively keep more of your dollars for yourself and for your family.